stage. We've been like having a lot of fun in this place. Everybody's in the other room, but thanks a lot for being here to listen Pierre Berthet, who is going to talk about pricing optionality in cross-assets Lightning Network payments. Pierre is from Galoy, and he will be talking to us about this kind of stuff. Remember that if you want to join to the Wi-Fi connection, the password is Bitfinex with a capital B. And also that the conference is just starting. Tomorrow we are going to have a lot of fun in El Salvador, Bitcoin country. And if you are ready to go, yes, let's go.
Hello. Hi everyone. So this is work we've been doing for the past few weeks. That's a free option issue. You may be familiar with that, and that's what's occurring when you have a multi-asset exchange using the Lightning Network payments. So brief outline. What is the free option? When does it occur on the multi-asset Lightning Network? How do you price this optionality using some model and the volatility and the risk associated with that? And then we'll say, what are some mitigation strategies that you can set up to avoid this or to mitigate this free option issue? And then some insight from the stable sets user on the Bitcoin Beach wallet. Okay, so the Lightning Network becomes multi-asset at the edges. So, for example, merchants, they can accept Lightning payment for the products that have been priced in USD. You have exchange or swap service also, or multi-assets wallet that allow some transaction with synthetic assets over the Lightning Network. And also, of course, there's some new protocols that are being developed that will allow for some more cross-asset exchange on Lightning, like DAO and RGB. So when does the free option arise? That's as a payer, you can decide when and whether actually to pay an invoice. And during that time, the price could have changed. As a payee, you can accept or settle or reveal the pre-image to settle the transaction. And during that time, again, you can decide to do this, actually don't, or when to settle that. And during that time, again, the price may have changed in one way or the other. And if you leave this optionality unpriced, this could be abused, and the user or the market maker, the offer maker, offer taker might be at loss or at profit, of course. So what is a call option or an option, as we've been mentioning this free option? A call option is the right, but not the obligation to buy a specific asset at a specific price within a specified time window. And it's usually not free, at least not in traditional finance. Is that a bad thing? Just an anecdote, there was something called the the Greenspan put, or it was also called the Bernanke's, or any of the chair of the Fed put. It's when the Federal Reserve would come in and lower the interest rate whenever the equities market would crash by some percent. So then this lowering of rates will allow some fresh money to come in, basically, pump up the equities price up, and all was well. So this is, in essence, a free put option on equities. So you can decide if this is a good thing or not. So some abstract example. I'll go here. Yes, boom. Oh yeah. Okay, we start at the top. You have one Bitcoin. You are the payer and the pay. You have one channel with an exchange in Bitcoin, another channel which is in SC, stablecoin, and you get an invoice. At the invoice creation, one Bitcoin equals one LC. You have a few minutes before the expiration of this invoice, and during this time, the price can have moved. Let's say the price of Bitcoin has increased, so the new market rate would be 0.9 Bitcoin for one SC. You would just let it expire and ask for a new quote, because you could get for the same amount for your one Bitcoin, you could get more SC. On the other hand, if the price of Bitcoin has crashed compared to the SC, let's say it's now 1.1, and for 1.1 Bitcoin for one SC, but you still have the invoice that says I will exchange 1 Bitcoin for 1 SC. Okay, so you pay that invoice, and then because you're the payee, you can also decide to reveal the pre-image, or you can wait a few hours until the expiration of the time lock, basically. And again, during that time, price can move, so it can again decrease maybe, or the price of Bitcoin will increase compared to SC. You're in this leftward set there. So 0.9 Bitcoin, 1 SC, is that good for you? Probably not, because you have 1 Bitcoin. You would end up with something that's worth 0.9 Bitcoin, so that's not good. You can cancel or just let it expire. You will get refunded 1 Bitcoin. That's what you had at the beginning. You don't lose anything. Good stuff. The price of Bitcoin, on the other hand, might have crashed, and now it's 1.3 for 1 SC. This you would pay because you still have one Bitcoin, oopsie, to 1 SC offer. This is what you're going to settle, and then you would get 1 SC, which is now worth 1.3 Bitcoin. So that's a win. It's either you don't lose or you win. So what are the risks? This was made-up number. That's were made-up numbers, just as an example. But what are the actual risks you can face during this time frame that are more realistic, like 2 minute invoice validity, or up to 14 days in somewhat the worst case for the settlement of if you have multi-hop routing payment. So we used the BTC price from last year, minute data, and to compute the formula, we used the formula, the Black-Scholes and Merton from the 1973, and this needs the spot price, the strike price, which is usually the same, and the volatility. The volatility, I'm going to show you how it looks. It's just how much change there is in the price. The risk-free interest rate, usually it's set to 0 when you're talking about Bitcoin. It's otherwise the treasury, the yield from the treasury bond in traditional finance, and the expiration rate. So this formula is kind of old, but it's still used. That's kind of the standard where when you have a new formula, you basically compare it to the BSM, the Black-Scholes Merton, 3 economists. So that's the 2-minute returns on the Bitcoin price for the last day, so since yesterday. So it moves, so by how much the price has moved in a 2-minute interval over the last day, over the time. It's not a lot, between 0.2 and minus 0.2. Some spikes are a bit more. Okay, that's the distribution for 2 minutes. That's how it is. Now, just to get some perspective, if you were to exchange, usually the exchange charge some fee, and you have plotted what would be 0.15% fee and minus 0.50%. So if you take the other side of the offer, so BTC to USD or USD to BTC. So for you to make a profit, if you're the user, let's say you're the user, you would have to be in one of the situations where it's where you're outside of the dealer spread. Otherwise, what you've paid to the dealer is not is in more than what you get from the return over the 2 minutes. Another way to show that is using the cumulative distribution. And here, now you can quantify basically where, so that's in red, where you're making money basically on the trade on this 2 minutes period. And in that case, so that's data from the last 24 hours, almost. And it's only like 5% of the trade would be profitable. All the other one would be covered by the price of the dealer's fee. But that was just a day, just like that. There was this, I had the data from that day, the November 10th, so a few days ago. Same spread, minus 0.15 to 0.15, but now it covers only 60%. This is just to show you that there's some volatility, the variability in the you know, that in the price of Bitcoin, it moves almost randomly. Some days are stable, kind of. Others can have larger volatility. Yeah, so right now only 60% covered. You see the red area are much larger. You could make a profit as a user on that much more easily. Now, if we look at the 14 days periods, and that's the same kind of idea. On top, the price of Bitcoin going down, and at the bottom, the 14 days return. So by how much the price has moved over a 14-day period over the last year. And on the right, you have the marginal distribution. So then it's the same. It's centered kind of around 0. The bulk of it is between, actually I haven't done the math on that, but let's say it's plus 15 to minus 15% is mostly that. It's a bit biased negative because we are in a bear market. And if we plot again the same cumulative distribution, but now with the 14 days data and still with the daily fee or the spread you have using the exchange, now it looks terrible if you're the exchange. It looks good if you're the user. Because now there's a lot of surface of attack where you will make a profit out of that, and the exchange will probably lose money on that. So now you can't really use the spread to cover for that. You've seen that before on the 2-minute invoice or the 2-minute expiration. That's just using the spread could potentially avoid most of the loss. And if you just sum the profit and the loss, you might be at 0 or even positive. But now with the 14 days, it's impossible. I mean, you would have like 20 or I don't know, 20, 30% spread. So that's not going to happen. Here in this bottom graph it's what would happen if the option was priced in. So if you, as in traditional finance, you would have to first pay the call option, and then you would be allowed you would have the ability or the possibility, the right, but not the obligation to take the subsequent trade at the rate set in the option. Again, call option, buying Bitcoin. In a bear market, it's mostly at loss. What this means here at the beginning is that you're basically paying at the option around $3,000 for the right to buy a $60,000 Bitcoin. You're not going to take it because after 14 days, one Bitcoin is worth 50,000. You're not going to exercise your option to buy a $60,000 Bitcoin. So you're at loss by 3,000. But there are some blue parts, and the blue parts are like 20% of the total trades if you trade every day. And this means you're at a profit, even accounting for the price of the option. So how can you mitigate some of this problem? Can we just price in the option and everything's fine? Or are there some other options? It's a fine balance between the user experience and what the exchange might accept as a profit and loss. Do you want, as an exchange, to make money with your exchange service, or is it okay to just be at 0 and you cover your loss with the bulk of your profit? So you could impose some restriction on the rate and the volume, and that could be non-specific, like 10 trades a day. But you kind of need to know some account on somewhere to define your users. You could set a maximum volume also, so that's kind of what's been done. For example, with RoboSats, you have 1 trade at a time, maximum amount. It could be some other stuff you can use if you have some way of accounting, like if you know the account number or the user, you can use their time to settle. Did this user took a long time on average to settle its trade? Maybe he's abusing the system. Maybe we should increase the spread or lower the volume or do something else. Spread as premium, I mentioned it. I showed some results already. You could base that on a option pricing model, or just try to balance so that you're dead even, so the profit equals your loss. I just shown this upfront premium, so that's the traditional finance way of doing. You pay for the option contract, and then you're allowed to take up on your offer for that specific price. Problem is, in the current implementation of Lightning, what happens with failed transaction, and these do happen. So you would pay for the option contract first in the first transaction, and then you have the right to buy or to settle the trade later. And then you decide later to settle that trade, but there is a problem. The payment is not going through, payment fails. So you paid for the option, you had the right to exercise the trade, but the payment failed. It's not your fault. You paid for something that you could not use. How do you do that? You actually don't. There's not really a good way to implement this right now in Lightning. So different solution. The evolution is kind of using the stockless payment, so then you would not have any failed or any decreased amount of failed transaction, and that may rely on the point-in-time lock contract. I'm not going to go into detail in that, but that's probably one of the best options. Some other results from the 2 minutes return. So let's assume you have the free option, you're an attacker, and you're using the 2 minutes invoice, so the first part, the payer part of the optionality. If you only complete for this specific day, as an example, if you only complete the red trades, so this is when you buy Bitcoin, and this is when you sell Bitcoin, basically, you could double your stack in 24 hours if you make an invoice every minute in both directions, basically. Yeah, you could double in ideal condition, which is not possible. So, but still, you can see that's kind of the maximum risk for that day. It could be lower, it could be higher in different days. Quick example with the spread. So if you increase the spread from 0.15 from the dealer to 0.33, you see that you start to lessen the surface of the possible attack from the user from this red region, red area to this one. So it's easy for the 2 minute invoice kind of. The spread is pretty good mitigation measure. You could also limit the rate of the trade. So if you say you can only do 10 trades a day or 10 invoices a day, 10 quotes a day even, then it's really hard because you're kind of sampling from this random distribution or randomly sampling from the distribution of the returns, and you're most likely to draw from something that's around 0. And if you're lucky, you can get maybe 1 out of this 10 red trade, which turn out a profit. So on average, I ran some simulation, 0.6% for 1 day of work, probably not so good. 100 trades a day can make some profit of it, but yeah. Okay, now we see for the 14 days horizon, the spread is not possible. Even the rate might be difficult to implement, but that could still decrease the amount of loss, of possible loss. Really, the best option is the upfront payment is to not have this free option. So it's to first pay the premium or pay the contract, and then have the optionality the right or to settle the trade at the specific rate. You could still make a profit with the option. I mean, that's a market in itself in traditional finance. But you kind of need to time the market, have some information about it, and yeah, that requires quite a lot of insight. So, but that's otherwise how it's done in traditional finance. So it's probably not too bad. One evolution of the BSM is that it doesn't take into account. So the volatility is a scalar. You could improve that by adjusting it to the recent volatility, so increasing the price of the option when the volatility increases. Just as an example, if you were to implement an option for a 2 minutes Bitcoin call option, that would be today around $8 for 1 Bitcoin contract. So some quick insight from the Bitcoin Beach wallet as a payer. So the 2 minute invoice, we kind of use the spread as a premium, so to mitigate the possible movement and volatility during these 2 minutes. But as a payee, it's actually only in situation is when Bitcoin Beach Wallet user is paying an invoice that was, that's in Bitcoin, and he uses his USD wallet, USD account to pay for the Bitcoin invoice. So it goes through the exchange. That's internally. The exchange sends the correct amount of Bitcoin to the external Lightning wallet. But this payment can fail. And it can fail for some reason. It can just fail. Maybe this external wallet is actually the same guy who holds the Bitcoin Beach wallet, and he didn't. Yeah, okay. For some reason, it can fail. And this can fail after some time, hours to days, and the price may have moved during that time. And if it has moved quite a lot, and you have to refund in USD, and the price of Bitcoin has crashed, how do you do? Maybe it was $10 at the time of the invoice of the exchange, and now it's like $7. What do you do? What we do is to refund the user in BTC. So this happens not a lot, like only 1% of the time. So that's mostly fine, but that's how it is. Just as an example, here is the payment latency on the x-axis. At the top you have the BTC payment, at the bottom you have the USD payments, on the y-axis you have the value, and it's color-coded by failed and settled transaction. So what's really interesting here is these guys in blue, mostly. So failed USD transaction, even though I just show you with Bitcoin Beach Wallet, you can't really access or have the possibility of disruption because we refund you in Bitcoin, but still you have some failed transaction, and that's just to stress the fact that it's not possible right now to have this upfront payment, because maybe this guy would have paid for their contract, for the option, and the subsequent trade would have failed, and what would you do with that? Okay, so quick summary. I didn't really mention custodial versus non-custodial. There are different options for the mitigation. So there are two main phases for the optionality, the payer and the payee. Many of the mitigation are actually a posteriori. You kind of need to know what the user have been doing before setting some restriction. Otherwise, you maybe start with blanket parameters. What about the block liquidity during the expansion time? That's something I didn't really mention. Yeah, I'll just stress out that what we think right now, it's not complete, but the PTLC's offer solution might be the most promising feature. Okay, I have some reference, but I'll skip that. So if you're running any exchange on Lightning, I'll be happy to talk with you. But otherwise, please enjoy the conference, and thank you very much.
Yes, great presentation. Thanks a lot, Pierre. And now we are going to have a great panel, but I'm supposed to do a little time with you guys. I hope that you are enjoying adopting Bitcoin. Remember, if you want to join the Wi-Fi, you can use Bitfinex as the passport on Adopt 21. That's the Wi-Fi of the event. Now we are going to have a really interesting panel with some of the great Bitcoiners that we already have in this conference. That will be about adoption, some technologies that could make easy the adoption of Bitcoin, and what are the trade-offs. The panel is named Adoption Technologies, Benefits and Trade-off. It will be hosted by the one and only